Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. Today, Monday, the People's Bank of China, China's central bank, cut its benchmark lending rates, a move which we have been anticipating since last week, and yet another strong sign of policymakers' concerns for a slowing economy. The one-year loan prime rate, LPR, on which most new and outstanding loans are based, was cut from 3.7 to 3.65% at the August fixing. The reference rate for mortgages, the 5-year LPR, was also cut to 4.3% from 4.45%. This larger cut to the 5-year rate suggests the central bank is particularly concerned about the housing market. More on this shortly, though existing mortgages will not be affected by the cut until Q1 next year. However, analysts today, like last week, argue that the cut will have little impact on stabilizing the economy. If there were strong demand before among businesses and households for these loans, these cuts would have been quite impactful. However, as we know, the demand simply isn't there. Quote, "The current weakness in loan demand is partially structural, reflecting a loss of confidence in the housing market and the uncertainty caused by recurrent disruptions from China's zero-COVID strategy. These are drags that can't be easily solved by monetary policy." End quote. And, quote, "So far, lower mortgage rates haven't translated into higher property sales due to the lack of confidence in large developers and the pre-sales model. Policymakers may need to implement more non-traditional measures or even some kind of intervention in order to restore faith in the property market." End quote. We remember last week Goldman Sachs, Nomura, Standard Chartered and others all lowered their forecasts for Chinese growth this year. Before this, the International Monetary Fund had also revised down its forecast for the Chinese economy this year to 3.3% from its previous 4.4%. And of course, this is all well below China's own official target of 5.5%. We should also note, of course, that the IMF made this change to their forecast before China's surprisingly poor official July data was published. Okay, now let's move on to one of the main reasons why the central bank is trying to stimulate the economy with these cuts. This is, of course, the housing crisis. In an exclusive report now being discussed by analysts and commentators, Chinese financial media outlet Caixin writes that China's bond market regulator is pushing forward a plan to help the country's cash-strapped property developers sell bonds, quote, "in the latest move to shore up the ailing real estate sector." End quote. Caixin explains that the interbank bond market self-regulatory body under the central bank held a meeting over the weekend with several private developers to discuss potential credit guarantees to back their borrowings from the bond market. Several analysts had anticipated such a move, that is, financing guarantees for certain developers. After all, last week we discussed a potential pilot program in which the state would provide direct guarantees for bonds for 6 developers, including China's largest Country Garden Holdings. The guarantees would be from China Bond Insurance Co. Limited, established in 2009 as China's first state-owned agency to offer financing guarantees for bond issuers. Quote, "China's real estate market has entered a persistent downturn since mid-2021, with the situation exacerbated by this year's COVID lockdowns and sliding sales. Many developers had been unable to refinance maturing bonds, forcing a record wave of defaults." End quote. Now, as we take a step back, these developments touch on an important theme. That is, if the property crisis is in essence an insolvency issue rather than a liquidity crisis, when the music stops, as it were, where will the losses and costs fall? Investors, households, banks, developers, or the government? The mortgage boycotts, which we have been following for over a month now, are in a way a type of hot potato between homeowners and banks regarding who will eat the costs when the music stops. But there is another element too. If the government absorbs the costs, how much of the cost will it be? And will it be the central government or the local governments that absorb it? Peking University Professor of Finance Michael Pettis has always had an excellent ability to boil complex financial processes into more digestible forms. This is what he observed on this question over the weekend. Quote, The mortgage boycott issue is tough to resolve because while the home buyers have a perfectly legitimate reason to want to stop payments, the banks have just as legitimate a need to continue receiving payments. Banks and home buyers, in other words, are fighting over which one of them should absorb the losses created by overextended developers, who in turn were overextended because that was the only way to play the property development game successfully. At some point, scapegoats will be appointed. But I would like to make 2 points. First, given conditions of soaring property prices, expanding liquidity, artificially high growth rates and surging debt, this was a problem that was going to emerge anyway in one form or another. It isn't a problem because a few bad apples unexpectedly engaged in fraud and deception. We will of course discover plenty of foolish and fraudulent behavior, as we always do in the late stages of a bubble, but the problem was systemic, and the losses were inevitable. Second, and more importantly, these conditions have affected many other parts of the economy besides the property sector. That means, with or without bad guys, we are going to see that there are a lot of hidden losses buried in various balance sheets. In that case, there will be more fights over who will be forced to absorb these losses. In the end, I expect this fight to devolve into one between Beijing and local governments. But until then, businesses and households will also be affected. End quote. Next up, China's severe heatwave is becoming more serious as drought, electricity shortages, and large-scale forest fires spread. Late last week, China issued its first national drought alert, a national yellow alert, 2 levels below the most dire level, as many parts of the south have experienced the country's longest and most intense heat wave in recorded history. From the upper reaches of the mighty Yangtze River to its delta near Shanghai, the waterway is seeing historically low water levels, with some tributaries in the southwest of the country even drying up. Indeed, according to a state-run CCTV report on Friday, 66 rivers in the Chongqing region, which saw 45 degrees Celsius heat last week, have dried up. Firefighters have been fighting forest blazes across the region over the weekend. Poyang Lake, a critical flood basin for the Yangtze River, has now shrunk to a quarter of its normal size for this time of the year. Most concerning with all of this is that most of China's main economic and manufacturing centers are located along or near the Yangtze River and its delta. According to state data published last Thursday, economic disruptions and damage from high temperatures in July alone conservatively reached over $400 million. This is expected to grow many times over in August as power shortages, fires, and crop damage all begin to bite. On this point, yesterday, Sunday, China's southwestern province of Sichuan warned of, quote, particularly severe power shortages, end quote, and that plans to resume electricity to industrial users in the province, originally set for Sunday evening, that is yesterday evening, would be postponed for at least another several days. We remember that Sichuan's industrial users have been rationing power supplies since last Monday. Sichuan is particularly vulnerable to disruptions due to drought and heat waves, as the province relies on hydropower for electricity generation. According to the provincial government, hydropower reservoirs provide 80% of the province's electricity, and local state media reported on Saturday water flow into its hydropower reservoirs is down over 50%. Now, we still need to manage expectations while we follow this developing story. If weather conditions improve in the next week or so, the damage done to the national economy from this ongoing heatwave may remain modest. However, if conditions do not improve, then this heatwave and the resulting drought may join the housing crisis and zero-COVID policy as the main factors devastating China's economic performance this year. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit the like button, and as always, anyone who wants to go the extra mile and help me keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. That is today's episode. Thank you so much everybody for watching. Thank you for the ongoing support. Have a great day, and I will see you all tomorrow.